Good evening, friends, and welcome to the faculty and chairman of Taxation Audit Quality Review Board, CA Dr. Raj Chawla. As you are aware, friends, now we have concluded with uploading of non-corporate returns and particularly returns of income where tax audit was not applicable. Now the entire profession is geared up for the purpose of completion of tax audits and uploading of tax audit reports. Tax Audit Quality Review Board, as you are aware, has been entrusted with the responsibility to ensure that the quality of tax audit is appropriate so that the tax audit keeps on assignment on tax audit keep on continuing. Otherwise, as you are aware, in case of GST, the audit has been dispensed with. So it is necessary that all the stakeholders who are engaged in the responsibility of doing tax audit are performing up to the mark. And with this view in mind, Chairman Dr. Raj Chawla and myself decided that let us have a series for 2.5 months till the conclusion of tax audit, covering various topics in detail. Friends, today we have a young technocrat, CA Nikhil Kacheshwar from Chhatrapati Sambhajinagar in Maharashtra. He will be guiding us as to how to upload the tax audit report, what are various precautions which we should take while uploading the tax audit report. Because as you may be aware, that Information Technology Act and host of other acts are there. So maybe when you are uploading the tax audit report from your own computer, and if you are also applying signature of digital signature of the client for the purpose of acceptance in quick succession, maybe what precaution is required tomorrow, whether the client will tell you that, okay, I never had occasion to go through that tax audit report. So all those issues would be in your mind, and Nikhil has anticipated those aspects and he will be dilating on it. Then clause number 44 on goods and services tax. This clause, I am told that consumes at least 30 to 40% of the total time consumed on tax audit. And therefore, this needs more than little attention. So what we have done for the entire 1 hour, we have kept presentation only on this particular clause, clause number 44 relating to GST. And we have two eminent faculties, CA Mukund Abhyankar, whose only forte is practicing in GST, and CA Shekhar Sane, both from Pune. And Shekhar Sane is a veteran lecturer. For decades, he is practicing in income tax, doing tax audits, and also has having puts in GST. So both of them will be discussing with us as to what is the responsibility as far as this clause 44 is concerned, and how a chartered accountant should approach this particular responsibility, what he should expect from the clients, and he should complete the tax audit. So these two aspects we will be discussing today. Chairman, Taxation Audit Quality Review Board, CA Dr. Raj Chawla. Today he is at Singapore, but considering the importance of this particular event and his passion for tax audit and the topic of taxation, he has also joined. So let me welcome Chairman CA Dr. Raj Chawla at this juncture, and also all the faculty members, CA Nikhil Kacheshwar, CA Mukund Abhyankar, and CA Shekhar Sane. So welcome to you and all the audience who have joined for the purpose of listening to the address by these eminent faculties. Over to you, Chairman, sir. Rajbhai, am I audible?
Good evening, everyone. Thank you, CA Chandrasekhar Chitleji, my chairman last year, Direct Tax Committee, and guiding me in this committee also. I also welcome CA Nikhilji, CA Shekharji, CA Mukundji, and all my dear participants. First of all, I welcome you all in this today webinar on uploading in precautions in uploading of tax audit report and GST in tax audit. So this is our series which we have started in this committee. So my dear colleagues, I welcome you all in a very important webinar from the series on tax audit practice session 8, precaution in uploading of tax audit report and GST in tax audit. Today, we are going to discuss precautions to be taken while uploading tax audit report and considering to be kept in mind the respect of GST during tax audit. As you all are aware, uploading of correct tax audit report is very important and crucial from the viewpoint of compliance with the income tax law. So it becomes very necessary to conduct the tax audit cautiously and file the tax audit report timely with accuracy. Continuing its efforts in improving the quality of tax audit, TAQRB bring out the webinar which will help and guide the members in enhancing the and improving the quality of tax audit. Our today's speaker for the webinar are CA Nikhil Kocherwarji and CA Shekhar Saneji for sharing their insight on their topics. Now, without any further delay, I would like to request Chitle sir to please start this session.
Thank you, Rajbhai. Now, let me hand over session to CA Nikhil Kacheshwar. As I have already informed that Nikhil Kacheshwar is a young and vibrant chartered accountant from Aurangabad, and he is having in-depth knowledge as far as tax audit is concerned and as far as information technology is concerned. Friends, in earlier decades, if you want to practice income tax, that is IT, it was necessary to know income tax law, that's all. But now if you want to practice IT, then you should be aware of two ITs. One is the income tax law and the other is information technology. So we are really fortunate that we have such an eminent young and dynamic chartered accountant, Nikhil Kacheshwar, who is abreast of both these ITs, the income tax law and the information technology. Therefore, the committee decided to invite him to guide all of us relating to the precautions and nitty-gritties that are to be taken by the professionals while uploading the tax audit report. So with this brief introduction, may I now request Nikhilji to address the audience. Over to you, Nikhil.
Thank you, sir. Thank you so much. Thank you, Chitra sir. Thank you, Raj sir, for giving me this opportunity. So I share my screen first. Yes,
Yes, the
is
screen
my
is,
screen?
yes, it is
Yeah.
visible.
Okay. Hello, sirs, and good evening to all. I am now presenting my presentation on precautions in uploading tax audit report. The everyone knows nowadays our responsibility is getting increased day by day. सिर्फ और सिर्फ टैक्स ऑडिट रिपोर्ट अपलोड करके फायदा नहीं होगा, उसकी रिस्पॉन्सिबिलिटी लेना भी जरूरत है और रिस्पॉन्सिबिलिटी डे बाय डे पूरी चार्टर्ड अकाउंटेंट पे आ रही है. तो उसके लिए जो प्रिकॉशंस लेना है वो बहुत इंपॉर्टेंट है, बिकॉज जितने ज्यादा प्रिकॉशंस maximize the precautions, minimize the risk. It is the funda. So I'll start with my presentation. First important part of the tax audit and every audit is documentation part. So documentation will minimize your risk for great extent. So what are the documentations you have to keep in with your audit evidence? That first documentation is the engagement letter. Now, engagement letter to the assessee or the client will clarify what is the scope, objective, responsibility with you and your client. So it will segregate the responsibility, it will segregate the scope, it will segregate the objective. So first, before commencing the engagement, before commencing your audit, before commencing your assignment, you should send engagement letter to your client, which will clarify the objective and scope for the objective and scope of audit, and extend your auditor's responsibility to the client. Because the client should know what you are going to do, what you are going to check, what you are we are going to be responsible, and what is his responsibility. Like for example, physical stock taking. It is not always possible for auditor to take a physical stock uh, and check every time physical stock. So it is this management's responsibility to check the physical stock. So many times you check the physical stock, many times management, you take the management's presentation, management's letter that this is the physical stock, it is there in the uh, factory premises, or whatever it may be, go down and everything. So identifying the responsibility, identifying the objective, and identifying the scope is very much uh, important. And therefore engagement letter to the assessee, engagement letter to the client is very much important from auditor's point of view. It is, but obvious, it is also that much important from the client's perspective, because he will be clarified that auditor is going to check this one only, and he is responsible for this one only. He will not be responsible for other things. So from that point of view, he will be very much sure that other things will be checked and clarified by him only. So what should be the contents? Content should be objective and scope of the audit, and it should be restricted to the provisions contained in section 44AB. Everything should be restricted to the section 44AB, because now the tax audit report will be governed by the section 44AB. The responsibilities of auditor, responsibilities of management, identification of applicable financial reporting framework, what are the accounting principles, what are the accounting standards you are going to apply. Everything should be clear in the engagement letter itself. A reference to the expected form and content of any reports to be issued by the auditor. Now, in tax audit, along with the tax audit, along with the 3CA, 3CB, 3CD, you also issue the 29B, 10B. So in that case, you all the contents should be informed in engagement letter itself. So depending on the constitution, depending on the nature of work, depending on the nature of business, you should inform your client that these will be the contents, these will be the responsibilities, this will be the objective, and whatever it is. So it should be informed previously itself. Next documentation is sorry. Next documentation is NOC from prior tax auditor. I'm a chartered accountant from last 14 years, but uh, NOC from tax auditor, previous tax auditor, is uh, is not that much important for such some auditors, but it is most important. You should take NOC from prior tax auditor before accepting the audit assignment, before sending engagement letter, because once the client give you offer letter, you have to take NOC from the prior auditor, and then only you can accept the engagement, accept the assignment. Third thing is authority letter. See, you are going to sign on behalf of assessee because his digital signature certificate is with you. So wherever you are going to attach that digital signature certificate, it is but obvious that he is signing, but you are signing on his behalf. So every time, whenever you are attaching the digital signature certificate, it's your responsibility that you should inform your assessee that these forms are signed with his digital signature certificate. So for that purpose, you you should take authority letter from the assessee, and and it should contain all the forms, all the tax audit reports, all the ITRs, all the balance sheets, all the P&L accounts, uh, and other forms. Then it should be inclusive list that the whatever wherever signature is required, it will we will utilize his DSC. Com- uh, practically it is impossible that every time you will ask your client to attach digital signature certificate. So uh, many auditors keep the digital signature certificate of their clients with themselves only. It is fairly it is fair practice, but before doing that, you should take authority letter from him that we are going to utilize this digital signature certificate. Next one is signed balance sheet, profit and loss account, and other statements, cash flow statement, everything. See, as you know that while uploading tax audit report, you should attach balance sheets, profit and loss accounts, and other forms along with the tax audit report. But many times we attach it with either without signature or signature of one or two directors. So it is very much preferable that take signatures of all directors, all partners, all trustees, all designated partners, whatever it may be, whatever it may the constitution is. Take all director signature before uploading your tax audit report. Because see, once you are attaching your balance sheet, the approving authority will be only one person because it asks for only one DST. So it will get approved by only one partner or one director. So if you are attaching the balance sheet with all director signature itself, then it will be authenticated document, and it is the document which is informed to the all directors, all partners, all stakeholders of the company, all owners of the company. Sorry. So it is very much important. Nowadays, any dispute happens in between the partners and directors. CAs are taken into account because the other director or partner has not signed on the financial statements. So he can very much take the stance that the financial statement is not informed to him or not shown to him. So it is a first and most important precaution that take signature of all directors on the financial statements. Next. Now, as you all know, these 2 months are very much important to us. And in these 2 months, we are busy in the tax audit report and finalization of audit, finalization of financial statements. In this important 2 months, the parallel thing you have to do is keep the record of digital signature certificate. See what happens. You start uploading after 25 September, 26 September, and on last moment, what will happen if the digital signature certificate is not there? Your assessee might not be available. Nowadays, the digital signature certificate is not that much easy to get, because every time you have to apply for the digital signature, you have to get the video recording of your client. So he might not be available. He might be out of India. So considering all these points, you should check your digital signature certificate now itself, so that you should be ready with your digital signature. What kind of checking you should have? That check expiry dates. It should be 31st October 2023. Check whether it is getting attached on portal. there are many technical errors that DSC is not getting attached on the portal. So it should get attached on the portal. Confirm whether you have access of logging of directors, partners, trustees, or designated directors, partners on income tax e-portal. See what happened now. If you are going to upload the ITR of company, let's say for example company, so you previous portal, old portal, you are used to doing used to update your digital signature certificate on company's login itself directly. But now what you are going to do, what you have to do is, in company's login you have to authorize one of the director or one of the partner through the company's login, and in that director's login you have to update the digital signature certificate. So it might possible that you have the companies or LLPs or partnership firms login portal, access to login portal, but you might not have the directors or partners login portal. So you should have that access, or at least it should get updated now itself, so that you can directly attach the digital signature certificate on company's portal without any hurdle. Confirm whether DAC is updated on portal or not. The digital signature, there might possibility that one person is having two or more digital signature certificates. So it is always advisable to check whether the digital signature certificate token which you have is updated and it is registered on the e-portal itself. So first you have to check, and this is the parallel thing, and you have to parallelly do this now itself, because last moment you might not be available token, might not be available digital signature, it not might be updated on the portal. So all these will create many hurdles, and without digital signature certificate, the e-filing will not be approved. Check software update also, because there are many companies which provides the tokens, digital signature certificate, like e-pass. So their software also gets updated. So you should update these softwares on your income tax portal, on your laptop, so that immediately it gets attached. So digital signature certificate is the most important part, because on last moment it will not be available. In preparation itself, create one format. See, tax audit report, as Chitai sir rightly said, there are 44 clauses. Now 40 on all 44 clauses demand for the many information. So while doing audit itself, if you create one format that this kind of information you are going to have, you are going to put, or you are going to fill in your audit report. So that audit report, that data you will have readily available while filling the tax audit report. If so, it is very much advisable, create one format in layman language, because your assistants are going to do it. So create one format, all sections 43B, 269SS, 269T, 40A, everything put there, and ask your assistant while doing audit itself, put the data there. So you will be ready with your data, and whenever you are going to fill the tax audit report, you can easily fill that data in the tax audit report without any hurdle. It will be very readily available. So keep this format handy while doing audit itself. Next is in preparation audit evidences. While filling data in the tax audit report, keep audit evidences readily available, because see, sometimes let's say you have done the audit in June itself, and you are filling the data in September. It is practically impossible to remember everything, remember every decisions you have taken while completing the audit. So the audit evidences and the documentation part will help you to remind whatever decisions you have taken. So all the, and for example, 43B section says before filing the return, before filing the income tax return under section 139, you have to pay all the statutory dues. If not, it will be disallowed. So on the date of filing the tax audit report, you should be handy with all challans of section 43B, so that you can easily report in the tax audit report that, see, this is all paid, and you know, need not remind everything that whether it's paid or not. Now next is disqualification. See, there are two types of disqualification. First is keep eye on number of audits signed, because as you all know, there are only 60 audits you can sign, and in firm's case it depends on the number of partners in the firm. Yes, 44AD, 44ADA, 44AE are not included in the 60, but for that also you have to keep the record. But this is the busiest session, busiest period of our chartered accountants. So there might possibility that you you go beyond signing the 60 audit reports. So it is very much important that you should keep track and keep record of the tax audit report signed by you. And second kind of disqualification, disqualification is not like that you are doing some fraud, but disqualification means there might possibility that you are ignoring one or two facts which might disqualify you from doing the audit of your client. So what are the disqualifications? So accountant, that is chartered accountant, which is defined in 44AB, clause 1 of explanation to section 44AB, which says the accountant shall have the same meaning as in the explanation below subsection 2 of section 288. Now what this explanation says, first the explanation says section 141 of subsection 3 of the Companies Act 2013, in case of company, if you are disqualified in 141 of the Companies Act 2013, in case of company, accept the tax audit report. In other case, first clause is partner, member of association or family. If the assessee is a partnership firm, you cannot be a partner to sign the tax audit report. If assessee is an association of person, you cannot be a member of that association to sign the tax audit report. If assessee is a Hindu undivided family, you cannot be a member of that Hindu undivided family to sign the tax audit report. So it is very much important. Next is subsection 3 of section 13, in case of trust and institution, which lays down the disqualifications. Third is the person who is competent to verify the return under section 139. If you are authorized to verify the income tax return itself under section 139, then also you cannot sign the tax audit report. Any relative of clauses 1, 2, and 3 above. So relative definition is also it is also defined. So what is the relative definition? Relative definition means spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, lineal ascendant descendant of the individual, lineal ascendant descendant of the spouse of the individual. So all these are included in the relative. If the relatives are in, let's say, partner in the partnership firm, then also you cannot sign the tax audit report. If you are officer or an employee, then also you cannot sign the tax audit report. If you are a partner or employee of the officer of the or employee of the assessee, then also you cannot sign the tax audit report of that assessee. If you are holding security of or interest in the assessee, if you are holding security or interest in the assessee, and it is defined that it should not be more than 1 lakh. So if it is less than 1 lakh, then you can accept the tax audit report or assignment. If you are indebted to the assessee, then also you cannot accept the tax audit report. You cannot sign the tax audit report. If you have given if you have given guarantee of third person to the assessee, then also you cannot accept the assignment of that assessee. For example, if somebody has taken loan from, let's say, State Bank of India, and you have given the guarantee of that person to the State Bank of India, you cannot sign, you cannot take audit of State Bank of India.
नाही असं ते ब्लर झाल्यासारखा आवाज येतो.
Sorry, hello,
उद्या चालेल. ठीक आहे.
hello.
You can continue, Nikhil sir. There is a
Okay.
voice from.
Okay. 10th clause is direct and indirect business relationship with the assessee. Now, this direct and indirect business relationship have two exceptions. First is these professional services which you have provided to your assessee, but obviously it is not in the business relationship. It is completely separate. And second is commercial transaction. If you, let's say, your assessee is a hotel, assessee is a restaurant, and you have taken the service of hotel room or food you have ordered. So this is the pure commercial transaction. It is not in the business relationship. Other than these two, all will become a business relationship. 11th clause, a person who has convicted by a court of an offense involving fraud and a period of 10 years has not elapsed from the date of such conviction. If it is convicted of fraud, then you cannot accept from the date of conviction till 10 years getting over. So in these 10 years, you cannot accept the tax audit report assignment. Sorry. It is very much important. Last year, when the new portal was introduced by the finance department, CBDT, so one issue was very much famous, or it was in highlight. That was the reporting difference in clause number 16. Now, what was the clause number 16? Clause number 16 was saying that you have to report the other income of the assessee which is not credited to profit and loss account. So many auditors, many members have reported that in clause number 16, salary, capital gain, interest on saving account, interest on FDs, mutual fund dividends, company dividends, everything. So the many members have reported that in clause number 16, and what CBDT has done, what new portal has done. In new portal, while processing the income tax return, what they did, they added these all incomes in your business income, and they demanded the additional tax on the added income. So it is to avoid such litigation, it is very important to go through the guidance note, which is which are guidance notes which are issued by the ICAI from time to time for uh, for tax audit report. So it will be it should be clause wise. Every clause is defined, every clause is reported in the guidance note. So you can refer the guidance note for filing the tax audit report. If you properly go through the provisions, properly go through the clauses given in the guidance note, it will be very much easy, very much easy to understand what to report and where to report. Because if you are going to report, for example, this clause number 16, if you are going to report the salary income, the personal income of the assessee in the clause 16 and tax audit report, they will add back this in business, because you have to report only and only the income related to business, which is related to business, but it is not credited to profit and loss account. Only that you have to show. So it is very much preferable to minutely check guidance notes before reporting anything in the tax audit report. So wherever you get trouble, you can easily refer the tax guidance note. Recently, the draft has been issued by the ICAI, and it will be finalized. We need to comment by 6th August. So that guidance note will be very much useful, very much handy for any trouble to your for reporting in tax audit reports. Next is provisions of income tax act. See, nothing is beyond provisions. Nothing is beyond ICDS. Nothing is beyond your income tax act. So for reporting in 3CD, all provisions should be checked properly, because many times what we did, we ignored the provision and we report as per our principles. But we should check provision first, provisions of the sections, then only you can report in the form 3CD, and it should be reported properly, and it should be with the with the audit evidence in with your audit documentation. So audit evidence is also important, provisions are also important, and guidance note is also important. If you keep track on these three things, there will not be any hurdle in tax audit report. Now, the most important part is a comparison of tax audit report and computation of total income, that is ITR form. See, many times what happens, you see, though it is not our responsibility, it is not our responsibility, or it is not our duty to file the income tax return of the assessee. But as you know, all practically we are going to file the income tax return of the assessee. We are going to authorize it through his digital signature, and we are going to authorize our tax audit report and balance sheets through his digital signature. So comparing these data is are very important. When you are filing the tax audit report, you should compare the reporting of tax audit report with the ITR form you have filled in the same software. Nowadays, every software provides the comparison data. It compares the income tax audit report and ITR forms clause wise. Every clause is completely defined. Every clause is completely compared in the proper format. So you should check all the data. For example, fixed asset depreciation schedule, 36 section, uh, there's 43B section, 269, 40A. These all sections are very important because this section 16 last year, which led to very much high litigations. So all these sections are important because uh, whatever you are going to report in the tax audit report, it will get reflected in the ITR form. If you have not disallowed, the CBDT and portal will disallow it and process the data. So to avoid the clerical mistakes, to avoid the litigations, to avoid the mismatch in the data of tax audit report and ITR forms, you have to check whether there is any issue in comparing the computation and total income. So it is very much important to compare the ITR form data and the tax audit report data. Minutely check all these points so that it will be avoid any future litigations based on the your tax audit report. Because see what happens assessee from assessee's point of view, it is not his duty. It is your duty to check tax audit report and balance sheet. So and ITR form. These three should be combined. Three should be parallel. Therefore, reporting should be properly checked. Reporting should be compared.
Nikhil sir, your voice is not audible. Please check your network, sir.
Hello.
Yes, sir.
Hello.
Yeah. You
Am I
can continue.
audible?
Yeah. Now audible.
Yes. So, it is not our responsibility to file his income tax return. It is not our responsibility to check his income tax return, and it is not duty. It is not binding to the assessee also to accept our audit report. So there might be conflict, but to avoid these litigations, you should check audit tax audit report and the computation thoroughly, so that there will not be any mismatch in the audit report. Because see, the next point is on that only. You cannot revise your tax audit report saying that it is the data is not proper. Only in three cases you can file revise your tax audit report. First is revision of accounts of a company after its adoption. For example, you have filed your tax audit report now, and its AGM is in next week. And in next week, if AGM some revisions happen in the AGM, then you can revise your tax audit report. Second, a change of law with retrospective amendment. If there is a change in law in retrospective amendment, then only you can revise your tax audit report to take that effect. But and third is in change in interpretation. If there is some change in interpretation of CBDT circular, judgments or notifications or provisions, then only you can revise your tax audit report. But if you have reported something which is not included in these 3 points, then you cannot revise your tax audit report. So before filing tax audit report, you should be very much sure that these all points are covered. You have compared the ITR forms with the tax audit report. You have gone through the guidance note issued by the institute. You have gone through the provisions of these provisions of the Income Tax Act, section 43, section, all sections related to PGBP. You have gone through the ICDS. Every point has been covered from ICDS. You have gone through the GST, other laws of the financial statements. So this will be increase. This will increase your quality of tax audit report, and there will not be any litigation related to your tax audit report. At least there will not be any mismatch between tax audit report and ITR forms. Revision is not allowed. Revision is allowed only in 3 cases. So therefore, you should be very much careful before filing the tax audit report. Thank you. Thank you so much. Thank you, sir.
Thank you so much, sir. Nikhil sir, we have the question from the participants. Little
Yes,
but
sir.
1 or 2 question.
Yes, sir. Yes, sir.
First question is, sir, whether in tax audit clause 44, detail report is compulsory or not? If client does not maintain the detail as per reporting requirement.
Sorry. Can you please pardon?
Actually, participant is asking about that clause number 44 and asking that if client does not maintain the details as per reporting requirement, what we have to do?
Sir, actually, clause number 44 is in next session, so it will be clarified in the next session itself.
Okay.
Yes. And what is the next? Any other question, sir?
Another is a general question. Someone asked is what to do. We have to sign the financial statement digitally sign or just mentioning SD to upload in the tax audit report.
Yeah, you can sign digitally, but as I already said, that you have to take authority letter from the partners. But see, digital financial statements is the main document. So it is very much preferable to physically take the physical signatures of the all partners and all directors, because they should be known. They should not deny afterwards that we have not signed this financial statement. So first you take the physical signature on the financial statement, and after that you can upload the same with the digital signature. There will not be any issue.
Okay. Thank you, Nikhil sir. Please stay with us. If anything for you, we are taking the question after completing the session. Now,
Yes,
I'm welcome to CA Sekhar sir. Please take over the session. Sekhar sir.
Yes, sir.
Yeah, please take over the session, sir.
Okay. First of all, I would like to just check whether I can share the screen. 1 minute. I did not share. Can you see my screen?
Yes, sir.
Okay.
Visible, sir.
Okay. Can I start now?
Yeah.
Okay. Am I audible?
Yes, sir. You are audible.
Good evening, everyone. And first of all, I would like to thank Tax Audit Quality Review Board as well as Chitre sir and Raj Chawla sir and other authorities for giving me this an opportunity to present my views. And since the tax audit is the upcoming agenda for the chartered accountants, considering the September month is on the cards, it's good that we are trying to refresh ourselves with this particular topic. Basically, I am required to cover only clause 44, which is the last clause of Form 3CD of the Income Tax Act 1961 as stipulated under the tax audit regime. Obviously, first we need to authenticate Form 3CA and then Form 3 or Form 3CB as the case may be for entities to whom provisions of audit under any other acts are applicable or acts are applicable. We need to use Form 3CA, and for other cases we need to cover Form 3CB, and Form 3CD is common for everyone. So let us understand the basic contents of Form Clause 44 of Form 3CD. Now, my dear friends, first of all, let us understand before we start really. Let us understand the real objective of the tax audit as to why the tax audit was introduced in the earlier period when the tax audit itself was introduced. So basically, the tax audit is supposed to assist the assessing officers or the income tax department in ensuring that the correct income is basically offered to tax. And you are required to understand the basic difference between the tax audit and the other types of audits, wherein the other types of audits stipulate that it is true and fair, whereas the tax audit is basically true and correct. So first of all, we chartered accountants are required to ensure that our reporting is accurate or at least significantly or materially accurate to ensure that the statement of total income or the income reported by the assessee is significantly correct with reference to the law. The only thing is that whenever there are issues of any interpretation or interpretations of law or maybe process or mechanism, in that case, the chartered accountant can add the notes in add his notes or his views in Form 3CA, wherein there is a lot of scope for chartered accountant to provide the data or the information. Wherever it is not possible, he can also give disclaimer. But for that particular purpose, you need to have evidence. And as my earlier speaker was talking about, the significant responsibilities on the chartered accountants, and therefore we should maximize the precautions. As I rightly take it from my previous speaker. Therefore, the precautions is the first part, as supported by the letter of representation, engagement letter, NOC, etc., etc. But let us understand the true objective that we need to really report the correct statement of income or the correct figures of purchases, correct figures of sales, etc. Our reporting must facilitate the administration of tax laws with the proper presentation of facts and figures with respect to the law. And therefore, that particular things, our institute has also given us the guidance note under the leadership of our CA Institute's forum. And I have tried to use many sessions of that particular guidance note for facilitating the members to correctly report on that particular clause. So there are dual responsibilities. Number one, first responsibilities to the client. Number second, the responsibilities to the tax administration or the CBDT or the tax authorities. And obviously nowadays the third responsibility will obviously lie, as we are a member of CA, to the various stakeholders. As and how the law will get developed, it appears that our responsibilities will only get elevated. There is a question of we getting our responsibilities getting lowered will not arise. There is a definite objective of the income tax department that ultimately, since the GST law is one nation, one tax law kind of a thing, I believe every participant or every CA will agree that in the longer run, the Central Board of Direct Taxes along with the GST board, CBIC or whatever, they will try to integrate their interfaces, or they will have a common interface between the income tax data and the data of the GST law. And obviously, according to me, the information which is required to be reported under the clause 44 is nothing but the beginning of the era that the interface between the GST law and the income tax law will get developed surely but slowly, and not slowly but surely. Why I am saying so? Because nowadays you are observing that the data which is getting reported in clause in form 26AS or the AIS or TIS is in such a way that on many occasions we only don't know that as to what our clients are doing, or on many occasions our clients may or may not disclose the data to us, maybe without intention, but obviously we come to know that our client is also doing that particular activity, or our client is also having an account in that particular bank, which is basically getting reported in AIS or TIS. And therefore, an utmost care must be taken to ensure that this particular reporting is correct. Before I start, let us understand a thing which is the practical thing. Recently, I come across a case wherein I observed that a very negligible portion of sales of a particular client or an assessee, where I was undertaking a stock audit, was not getting reported by himself, nor by chartered accountant, because they were of the opinion that that particular sale was very negligible. And they were of the opinion that that particular sale is basically routed as a part of Paytm activity or Google Pay activity. And since the Nationalized Bank did not allow them to route those transactions via their cash credit account, they are just acting one current account with another private bank, and the negligible sales are whatever is being reported out there. It is not getting foreign part of the income tax P&L, nor it is foreign obviously as GST. Neither the GST is being paid on that, so on and so forth. Therefore, obviously, a question will come in the eyes of the tax authorities, both income tax as well as GST, that as to whether, from income tax point of view, whether the assessee has paid correct income tax on the taxable income, and whether the assessee is paying correct GST on the sales or on the supplies that he has made during the course of his entire financial year. Now, although the tax audit per se era has gone, but still the reporting in form 9C, etc. is still on the cards. And although we chartered accountants are not required to basically carry out that particular audit as a GST audit in the earlier era, now since it's abolished or it's not there, but still the responsibility is very much there. We are yet required, or we are just called by our clients to assist them in uploading that particular 9C or any other data, wherein we are supposed to be also filing the GST data. The responsibility becomes more enormous or more larger when a particular chartered accountant is handling both income tax as well as GST. That means both direct taxes and indirect taxes, whenever this particular reporting is of the important play. If at all that particular responsibility are handled by different chartered accountants, still I believe that both the chartered accountants who are handling the taxation, direct and indirect, must come together and they should discuss, and then the final reporting must be made in the interest of the assessee and in the interest of the government and in the interest of every stakeholder. With this brief introduction, I would like to just go through the basics of the form clause number 44. And before that, I would like to just say that it was introduced on 20th August 2018, and the year AY 1819, this reporting was not applicable. But later on, it got made applicable. And now, as we are rightly understanding or knowing that artificial intelligence is playing a significant role in capturing the data, in sending notices based on the system reporting or computer software reporting rather than a logical reporting. They don't check the notes, they only check the figures, they only cross tally the figures with the figures which are reported in the tax report vis-a-vis the figures which are reported in the return of income. And if at all there are mismatches, the CPC or the authorities, the computer authorities are directly adding that particular data on their income. And therefore, the times are not very short that now the entire system will be revamped and the logical data will be assessed more systematically or more thoroughly. Based on this, let us understand as to what is the reporting requirement. Number one, it is clause 44. We are required to report the total amount of expenditure incurred. Then that particular expenditure is further segregated in column number 3 to column number 6, which that is relating to goods and services which are exempt from GST, and did not explain what is exempted supplies. Then second is what are the goods or supplies which are falling under the composition schemes, as we are rightly knowing that a composition dealer cannot collect GST separately he has to issue bill of supply. He cannot issue tax invoice. And more importantly, he must write very clearly on his invoice that he is a composition dealer. Although you will find out that in many cases, composition dealers are not still following that particular discipline. And Abhinger sir, I may stand corrected if I am wrong, that many composition dealers are not writing that particular clause that they are composition dealers. And basically, they are not eligible for any input tax credit, but still they are not mentioning the words bill of supply. They are neither mentioning that they are composite dealers. They are just writing the words either bill or supply. Fortunately, they don't levy the GST separately. That's a good or fortunate part. But still, I believe that the times are not sure. The times are not gone. Now the department will definitely try to catch these particular dealers also. So income tax department will share its data to GST department, and GST department will share its data to income tax department. That time is not far off, according to me. Third is relating to other registered entities. Now here we are required to check whether that particular entity is registered or not. Now, according to the best interpretations of mine, the registered entities are the entities who are registered under the GST law. Now, for getting registrations, there are several provisions. There are several locations. A person can also obtain various registration under one state also. In one state also, that particular assessee can have multiple registrations. In across India also, obviously, that particular person will have various registrations, and accordingly, he will have his business getting governed through various entities like branches or warehouses and whatnot, or sales office and whatnot. And therefore, care must be taken by a chartered accountant that the information is compiled while certifying this particular clause 44, that the entire contra entries, that means the branch reconciliation or the warehouse reconciliation or the data with respect to the locational issues, is being properly reconciled, matched, not only with respect to the value, but also with respect to the quantity part. Now, I would like to also invite your attention to the fact that inventory records are part of the system of books of account. Section 4488 of the Income Tax Act talks about the books of account, and in that particular case, they have stipulated in Rule 6F of the income tax rules that you are required to maintain such and such books. Now, I would like to just take to you guys to the practical era, that you will find that there are many doctors who are not at all registered under the GST law. But if at all a particular doctor is rendering his medical services, the per se medical services are not falling or not covered under the GST law. But if at all that particular doctor has given his property on commercial basis, then his exempted services turnover and his taxable turnover will be calculated for the purpose of registration. And perhaps basically the GST department would like to also have such details in future from the income tax department, and vice versa, that whether a particular person is supposed to be collecting the GST or supposed to be paying the GST, irrespective of the fact whether he collects GST or not, that particular questions will come up and the notices will be issued according to me. Because nowadays that particular assessee, say a doctor or a lawyer who is not per se required to be registered under the GST law, will be required to pay GST on such taxable portion which are covered as taxable supplies, and therefore that particular criteria is required to be thoroughly checked by the chartered accountants. And in case we are finding that that particular person is not paying that particular liability, is not registered under the GST law, then we must inform that particular person that you are required to register under the GST law, irrespective of the fact what he tells you. Because if at all that particular information is found out later, then the assessing officer might question you, because we are also required to check and report on various other clauses under the Form 3CD. For the purpose of this lecture only, we are talking about clause 44, but there are various other clauses by which we are also required to check and report whether the reporting or the payment with respect to any other indirect taxes or any other statutes like Provident Fund, Profit Tax and whatnot, they are also being adhered to by the assessee or by the client, so to say. And therefore, according to me, this is just the beginning of the era that the tax audit data and the data of the income tax will be shared simultaneously by each departments with reference to generating or with reference to elevating the tax base across the country. As we are observing that after demonetization, the tax base has started growing up. There is a significant increase in the electronic transactions, and therefore there are hardly any areas by which a person or a client or an assessee is evading either the income tax on the taxable income portion or the GST on the taxable supplies, so as the case may be. Therefore, with reference to these particular registered entities, I would like to further point out that our ICAI guidance note has also stated that the type of assessee or the type of the supplier which is prevailing at the time of supply is important. For example, if at all a particular supplier is GST registered whenever he is supplying the goods or services or both, that particular reporting is relevant, irrespective of the fact whether that particular supplier becomes he is not registered later on, or he cancels his registration and whatnot, or he does not file the returns later on and his registration gets automatically cancelled. But what is important from the point of view of the chartered accountants is that we are required to check what is the real status of that particular party who is supplying goods to our client as to whether that particular entity was really a registered entity or not at that time when that particular party has supplied the goods or services or both. And therefore, according to me, our focus should be that we should check and take also a representation from the client that we have checked the data of the registered entities based on the timing at which they were required to supply. We have taken into consideration the GST, that particular party as a registered entity based on the GST registration portal or the GST data or the GST registration number at that particular point of time. In other words, if that registration gets cancelled later on, in that case, we are not at all responsible for reporting that particular entity as a registered entity, although that entity's registration number may get cancelled later on, or it is suspended for the timing in force. Next is the expenses on the entities relating to the entities which are not registered. In our typical old era language, these entities are called as unregistered entities or the URD, so to say. Therefore, for we chartered accountants, the first and foremost control is that the serial number 2, is the control total. Serial number 2 is the control total, and serial number 3, 4, and 5. Serial number 3, 4, and 5 is put together so as to make the row number 6 or the serial number 6, and then that particular total of 7 and the 6 must match with serial number 2. Now, my discussion is, you may find that particular discussion a theoretical decision. I'll repeat that serial number 6 and serial number 7 put together must match with serial number 2. And if at all it doesn't get matched, then an appropriate reconciliation must be in place. And so as to explain during the course of an assessment that whether that particular registration, whether that particular reconciliation is significantly evidencing the fact as to the reporting under these particular clauses correct. So, 3 objectives. Number 1, reporting of this particular data. Number 2, the books of account. Number 3, the correlation or its linkage with the GST data. So, GST data and income tax data must be put together. Now, someone has asked the query which I was just listening to. Although I am not an expert in this particular line, Abhyankar sir will also throw some light on that particular matter later as well. But I would like to state that what ICAI or what Income Tax Department is basically asking us to report only a total figure. And according to me, we are not required to give headwise figures. However, while giving, if at all the data is limited, if at all the data is restricted to say 20 or 30 row items, you may or may not add 20 or 30 rows and put the data headwise. So both the avenues are possible. Either you report the data headwise or you report one consolidated figure. The choice is with you. But whatever choices that you will have, or whatever choice that you will have, it is better that you explain that particular logic in notes in Form 3CA, because it will protect you. I'll once again take the cognizance of the first speaker that our protection is very much important and the precaution is very much important, because right now the entire reporting has really become technical. And since the assessments have also become faceless now, our face value really has very, very limited meaning. The system is basically superlative, or the system is overplaying the knowledge base, or the system is basically overplaying the council's ideology or council's mindset or the council's ethics, and therefore it is important that our reporting is system based or the risk free. That's what I will put it that way. Therefore, the reporting for 6 and 7 must match with 2. If not, you must have the reconciliation prepared in this particular line. Now, very importantly, the reporting under this particular clause is important for the entities who are registered under the GST or not. As I given earlier an example of a lawyer or of a doctor who may not be required to be registered under GST law, but if at all they are rightly or wrongly not taking the registration, whatever, in that particular case, you are still required to report that this particular clause is applicable, and therefore, as if they are registered under GST, you are required to report under these clauses, that is clause number 2 to 7. Number 2, as I was already pointed out, that you may report headwise or you may report as one consolidated figure. The methodology of reporting must form part of 3CA. The status of the supply as on the date of supply is important, with as to check whether that particular person is really registered or not on the date of the entity when that particular supply has happened. Later on, what is happening or the events occurring after the balance sheet date or events after the supply, we are not really concerned with too, and therefore that part must be taken on the letter of representation from the assessee or the client, as the case may be, while reporting this particular clause. Next is that in order to verify the desired details, it is important that we are requiring our client to check, to give us the data in the following order. Number first is expenditure head. Number second is name of the entity to whom payment is made. Number 3, GSTN of the party. Number 3, next is value debited to expenditure account. Then the total amount paid to vendor. And last is reason for nil GST. Now, you are quite experts in understanding these particular clauses, but I would like to invite various GST provisions which are far more dynamic in the recent eras than the static in nature. Nowadays, we are required to take the cognizance as to whether a particular payment to a vendor is made within 180 days. Now, we are also required to check whether the invoice-wise breakup is available with the vendor or the client. Number 3, whether the reconciliation is properly made between the parties who are transacting amongst each other. That means my purchases are becoming sales of another party and vice versa. And therefore, we must reconcile our books of account. We must check and ensure that the invoice-wise breakup is also getting matched with the outstanding balances. And for that, the discipline at the client's level or the entity's level must be there in as well. Now, the typical problem may arise when a particular entity is a supplier. That means as he is selling the goods as well as he is buying the goods from the same entity. And therefore, in that particular case, there may be a trade-off or there may be a journal entry which is getting passed for the netting off of the transaction of the purchases and the sales. That means the debtors and creditors might be getting squared off by a JV rather than actual movement of cash flow. And therefore, the chartered accountants are supposed to check these particular data very thoroughly as to whether the invoices are properly knocked off with each other with reference to the reporting under these clauses. Because the danger of getting our client paying to the vendor within 180 days is crucial. Because the law of the land stipulates that if at all we don't pay to the vendor, then that particular input tax credit is not eligible. And whenever we make the payment, then that particular GST credit is eligible for an assessee. And therefore, we must also check whether the correct books of account are maintained by the client along with the correct account heads. So there may be account heads like input tax credit eligible, then the input tax credit availed, input tax credit utilized, so on and so forth. They must be checking or passing the entries for setting of the output liability with the input tax credit which is finally eligible and which can be availed legally. So that particular criteria or the logical checks must be inbuilt in the computer system so as to ensure that that particular amount is correctly reflected in the books of account. Why I'm saying so, my dear friends? Because in the subsequent year, whenever that particular GST credit is not eligible, and if at all an entry is passed by debiting the profit and loss account and crediting the current asset, then the income tax department may treat I'll repeat, income tax department may treat that particular item as prior period expenditure, and the assessor will obviously argue that the event has happened in the current year, and therefore that item is not a case of a prior period. Therefore, why you are disallowing my cases? But right now, as I told you, that there is nowadays a artificial intelligence or system logic being overpowering the knowledge base or the notes case or the case laws which are prevailing in the land in our country, and therefore an utmost care must be taken to ensure that the reporting of prior period items or the prior period income may be debited or credited, or maybe net off or being displayed or demonstrated on the face of the P&L and whatnot, or in the notes of account. That particular reporting also must be taken care over here. Now, over and above various other criteria like exempt supplies or the nil rated supplies and whatnot, our endeavor or our efforts must ensure that reporting under that particular clause is being there. And if at all you find anything which is fishy or you don't agree with any particular thing, or wherever there are limitations to your exercise of verification of the reporting under these particular clauses, you may also straight away disclaim either with respect to a particular expenditure head, or with respect to the gross amount, or with respect to a particular branch, or with respect to a particular location, or with respect to a particular state, or with respect to a particular vendor as well. Because right now there are various areas like areas wherein search or seizure are getting carried out by the tax department, and whenever such cases are being carried out, the GST department may deny the input tax credit. In that case, wherever there are falsifications or frauds or errors which you may or may not aware of, or the client may or may not tell you those things upfront, and therefore it is imperative or it is important on your part to ensure and note that you take the letter of representation that the input tax credit is correctly availed by the assessee while reporting under the tax audit clauses as well. Therefore, an appropriate disclosure is required, and the total expenditure meaning is required to be filled in properly. The data or the disclaimers or the disclosures or the picking of the data, system related issues, ERP issues, the controls or the totality checks or the safety issues must also be added to. Also, although the audit trails are being made mandatory from 1st April 2023 under the Companies Act 2023 on any software, right now it is applicable for the assessee who are companies. But the times are not off when those particular audit trails will be also made applicable for the assessees who are not corporate entities also. And therefore, you must check and ensure that the transactions of cash payments above 20,000 where there is a standard customary or the unwritten customary that you split the vouchers as below 10,000 and so on and so forth backdated, or the change the license and make the softwares upgraded so as to ensure that those things are not captured at all. Those things will be now taken care of under this particular reporting so as to ensure that the payment is made within 180 days. So you need to really check and ensure that the reporting under these clauses is absolutely proper. Last but not the least is that you need to also check whether the bank reconciliation statement or the bank reconciliations are also made properly by the assessee, because the payment criteria of 180 days will straight away hit you and in reporting of your eligibility of the input tax credit. And therefore, utmost care must be taken of the balance confirmations, payment within 180 days, balance confirmation, breakout of the outstanding amount, tallying and reconciliation of the figures, so on and so forth. The next is you need to have the total of the expenditure. So you need to check that the expenditure is taken into what is expenditure. That particular expenditure is nothing but the definition is according to me quite elaborate. And our institute has also in its guidance note has given the same format whatever I am reporting over or reproducing over here. Thanks to ICAI for giving us the guidance of this guidance note, and to all the people who have really given us this guidance note. That the terminology of expenditure does mean that it also covers the revenue expenditure as well as the capital expenditure, because the total expenditure is of the different gamuts, and therefore you must explain in the notes that although the reporting of under the clause 44 is made with reference to the capital expenditure and revenue expenditure put together, your notes in form 3CA must state that the reporting is made by considering the total expenditure as capital expenditure as well as revenue expenditure. Otherwise, the AI or the artificial intelligence or the CPC will directly check as to why there is a significant difference between the clause 2 of that particular entity or clause 7 of that particular entity's reporting vis-a-vis the total expenditure which is debited to the profit and loss account of that particular entity. And therefore, there will be obviously mismatch, because the moment you include the capital expenditure under this particular head, then this particular expenditure will be, or this particular reporting will be definitely far more excessive than the total amount which is debited to the profit and loss account. Therefore, our ICAI has also stipulated this particular standard format in the guidance note, which I'm just trying to reproduce over here, that you check the total value of expenditure, add capital expenditure not included in P&L, then less total value of non-cash charges. The best example of these non-cash charges are bad debts which are written off, number 1. Number 2, depreciation. Number 3, provision for diminution in the value of investments. Number 4, the security attempts or the loss on sale of shares or so on and so forth, which are not per se purchases or which are not per se relating to any registered entity or unregistered entity, so to say. And therefore, you should exclude reporting under all these clauses in the reconciliation statement. Last but not the least is depreciation, and therefore depreciation also should be ignored while considering the total payments under this particular criteria. And therefore, the value which you are arising at clause 44 is basically significant. I would like to also invite your attention to the fact that there is significant difference between the 3 words. Number 1, amount. Number 2, cost. And number 3, value. According to me, value is a larger concept. And obviously, Abhinder sir or other experts will throw light on this particular topic as to what's really different between the term value and the term amount and the term cost. And therefore, the reporting parameters which are stipulated are with reference to values and not with respect to the cost or the amount. And therefore, you must ensure that whenever an asset is being reported, that asset, if at all that asset is in the nature of plant and machinery or furniture or air conditioner or building, so as the case may be, in that case, you must check that the input tax rate is not availed on the buildings. Because the law of the land under the GST law stipulates that the GST credit is not eligible for immovable property. And therefore, perhaps the income tax department or the GST department would like to exchange this particular information, because in the earlier clauses of capital expenditure or the additions to assets, it is clearly stated that whether the particular assessee has excluded from the cost of the asset that part of the portion which is claimed as input tax credit or SENVAT in the earlier era while reporting or while accounting for that particular asset. And therefore, in building, perhaps on the portion of GST, the assessee is supposed to claim depreciation, and therefore that particular amount of the GST portion will be obviously forming part of the building. Unlike the cases of the machinery or furniture or air conditioner or the office equipment or any such asset which is used for the purpose of business or profession, as the case may be. And therefore, according to me, the total reconciliation must be location based, the state based, the GSTN based, and the various other reporting entities based, MIS based, so on and so forth, so as to ensure that you are prepared for the assessment factually. That is the ultimate objective, according to me, by introduction of this particular clause. Otherwise, there was no per se requirement on the income tax department's part to even introduce this particular clause in Form 3CD, because these are two different laws. But nowadays, since GST and income tax both are being monitored by the central law, therefore, according to me, they will surely interface. I'll repeat, the interface between these two departments. Now, in clause number 5, value of all inward supplies from the registered dealers other than supplies from composite dealers and exempt supplies are required to be mentioned. In clause number 6, the total payments payment made to registered entities, the language used under the subheading of column 6 is total payment to registered entities. Thus, the word payment should harmoniously be interpreted as expenditure, and basically that particular expenditure in respect of the entities registered, etc. And therefore, some total of values reported in column 3, 4, and 5 must get matched with column number 6. Then in column number 7, expenditure related to entities not registered under clause under the GST law, and that is column number 7. Therefore, earlier I was stating that column number 6 plus column number 7 will have a common play with respect to the total number 2. So total number 2 must get matched with total number 6 and 7. And this, the reconciliation, whatever I was trying to make my effort on, must be made available to an assessing officer, whenever it is asked for during the course of assessment, and a proper reconciliation must form part of. Now, whenever practical difficulties are arising, I would like to state that these particular difficulties can be removed if at all you are trying to check them on basis of the materiality, that at least 80% or the 90% of the data of the assessors are really captured, and therefore the error of sample is hardly any minimum, or it is reduced to at least zero, at a very zero level or a very, very negligible level. So, as Sridhar was rightly saying in his opening remarks, that nowadays it is understanding of the law plus the understanding of the business of the SC, plus the understanding of the computer system, plus the understanding of uploading techniques, plus the precautions which are supposed to be taken care of while providing the details is of the utmost importance. Going back to the era, as I already suggested, that in serial number 5, you can add notes with reference to your disclaimers or with reference to the entities as to how you are arrived at the values. Once again, I'll repeat the words that the word value is being focused and not the word amount or cost. And therefore, the reporting must be with reference to the value, and utmost care must be taken care to ensure that that particular disclosure is correct. I'll repeat once again that the reporting under clause 3CD is gets ended with the term true and correct and not true and fair. And therefore, this particular reporting must be prepared according to me by the SSC, because form 3CD is supposed to be prepared by the SSC, and then we are supposed to check as an auditor or as a tax auditor. This point I had already covered, that the following amounts can be excluded, but mind well, these particular amounts are supposed to be taken into consideration while preparing the reconciliation. Now, there are certain developments with reference to the eras that under the CSR, if at all you are undertaking any expenditures, then the GST credit on that particular expenditure is not allowed. And therefore, although the CSR per se is not an allowable expenditure, it's section 37, also it is not allowable under the income tax law, still the reporting must be correct, and you must ensure that client is not claiming that particular deduction of CSR either directly or indirectly, unless it is stipulated under chapter 6 of the income tax law by way of donation or otherwise. And therefore, an utmost care must be taken to ensure that this particular reporting is also correlated with respect to the CSR reporting in case of an entities wherein their profit is more than 5 crores, and the reporting under section various section 198 I believe Companies Act 2013, that aggregate of the last 3 years average profit, so on and so forth, they are required to contribute 2%, and they are required to arrive at a different methodology for CSR. Although this is not the relevant topic, but I would like to invite your attention that you should not allow your assessee or client to claim input tax rate on CSR. Now, I have tried to interpret this particular session, and I would like to put forth my views as to what will really happen in future for the next 10 minutes, and then I would like to conclude my communication or my views on this particular topic. Under clause 10A of the and 10B of the tax audit report, we are also required to report what is the nature of business or profession. In case of more than one business or more than one profession, we are supposed to be getting that data correctly entered under the codes wherein we are required to report, or whenever the client is filing the return. So all his business entities, business names, nature, types, which may be also getting correlated with the Shop Act, Shop and Establishment Act, wherever in states these provisions are applicable, or wherever the GSTNs also are having in different names or under PAN, that particular under one PAN, obviously, the care must be taken to ensure that all these businesses or entities are reported, because in various acts, various sections of the income tax law, it is being emphasized that expenditure, if it is incurred for the purpose of business, then and then only that particular expenditure is allowed as deduction under the income tax law. And therefore, the GST officer can exchange the information, or the income tax department can also exchange the information with the GST department that that particular entity is having certain expenditures incurred like membership of club or repairs and maintenance of the motor vehicle, wherein there are block credits, and therefore the assessee is not allowed the input tax credit. Now, herein the P&L account must be having the debit of the basic value of the repairs cost plus the GST on that particular cost, and that particular amount is not eligible as input tax credit. And therefore, according to me, the information will get exchanged between the two departments. Now, clause B is very dangerous. If there is any change in the nature of business or profession, then the particulars of this change. According to me, if there is any change in the business or profession, in that particular case, if at all there are eligible input tax credit matters, if at all they are becoming non-eligible, so the correlation or the reconciliation exercise must be prepared by the assessee before filing the return, or an atmosphere is taken to ensure that true and fair view is first taken in the books of account, and then the reporting is correctly made in the tax audit report if at all you are finding the things are materially wrong. Second is clause 11 A, B, and C. They are talking about books of account, and as I've been emphasizing that inventory records are part of the books of account under section 44 AA rule 4F also. Doctors also required to maintain the consumption of drugs, etc. And there are various case laws that inventory records are forming the integral part of the books of account. Without inventory records, the true statement of the total income or the true taxable income cannot be found out. And therefore, this particular item may be correlated with the fact that if a particular dealer is buying certain goods, and if at all he is distributing a part of that, say 1%, as free samples, then that particular free sample, on that particular free sample, input tax credit is not allowed. And therefore, care must be taken to ensure that the true and fair profit is first stated, and then the taxable income gets correctly calculated, because that particular information may get exchanged between the two departments. Number 3 is method of accounting. Obviously, there are several or plethora of case laws. Cash method, accrual method, so on and so forth. Under the GST law, there are riders for 180 days. There are various other riders also as to the eligibility of the input tax credit. So first there must be eligibility, then there must be availment, then there must be utilization. And based on these 3 principles, the total mechanism of input tax credit will get governed. And we must check and ensure that this particular reporting of clauses 13A to F are also being correlated with clause 44. My dear friends, I have just tried to jot down these particular clauses as if I'm a learner, because although we are knowing that, although we are chartered accountants, every day we must learn. Then unlearn, then again learn. Unless we follow this particular mechanism, we will not improve. And therefore, I just thought to put forth my thoughts in front of you so as to ensure that in the future, these clauses may be getting correlated by both the departments. Then very important thing, which the clause number 14A and 14B, which are very much closer to our hearts as well as of the assessee's hearts, along with section 145A of the Income Tax Act, as to how the inventories are getting valued and whether there is a change in method of accounting. This particular clause can be correlated with section clause number 727A of the Form 3CD itself, wherein they are talking about the segment credit opening balance, then availment and the utilization, and as to what kind of treatment that you are giving in the books of account. Usually the clients, many of the clients, they follow exclusive method. That is, they separate the taxes collected on the supplies and they net off with the input tax credit which is eligible, and only the final payment amount is being disclosed as a liability under the current liability side. Or if the input tax credit amount is more than the taxes collected, then that gets reflected on the current asset side, that means on the balance sheet asset side. So accordingly, we need to disclose that particular fact in our tax audit report, and therefore we must ensure that the balances under these particular clauses are also getting matched with the books of account. Therefore, clause 44 is required to be correlated, or its reporting is getting correlated with clause number 10, 11, then 13, then 14, then 18. As I was earlier stating, that on buildings or the immovable property, the input tax credit is not really eligible, and therefore the question of availability, etc., doesn't arise. We must claim depreciation on the same, and therefore assessing must ensure that the depreciation is being correctly taken net of the input tax credit amount, which is availed as input tax credit, and then only depreciation is claimed, so as to ensure that there is no double claim of depreciation as well as the input tax credit. Third is next clause is clause number 35A and B, wherein we are required to report the quantitative details for the trading concerns as well as the manufacturing concerns. And my dear friends, department has stipulated that in the guidance note, they are stipulated, I believe, certain percentage like 5% or 10% or such material amounts of the total figure. At least for such principal items, the disclosure must be made. It has been observed by many entities that many trading concerns or many manufacturing concerns even do not report under this particular clause 35A and B. According to me, this particular clause is very much important because your goods movements are being presently tracked by way of e-way bill and whatnot, and then the CCTV camera on the toll nakas, etc. And therefore, that particular fact must be getting already available on the record of the various government departments, and therefore the care must be taken to correlate reporting of clause 44 in this particular line also. Last but not the least is clause 40, ratio analysis, wherein we are required to report gross profit and net profit over and above material consumed ratio and whatnot. As I have been telling you, you must be agreeing that any change in the input tax credit eligibility and whatnot will obviously change our gross profit. Once gross profit changes, there is a consequential impact on net profit also. So therefore, the reporting under this particular clause is also having the implication of the reporting of the previous year as well, because we are required to report the two figures. One is the figure of the current assessment year and the previous assessment year, as the case may be. Therefore, that particular thing must be there. Now, under the GST law, you are required, every registered person is supposed to have these particular records, which are mandatory records, like inward and outward supply of goods or services. ICDS 2 makes mandatory for a service provider also to consider the or value his inventory as for ICDS 2 as well. And therefore, an effort or an endeavor must ensure that true and fair must get initially stated in the books of account as an audit, and then under the tax auditor report as true and fair, true and correct. And therefore, if at all there is any income which is concealed or escaped, then on that particular item, the GST department may call for the supply on that particular supply as the GST portion. In that particular case, whenever that particular amount will accrue, then input tax credit available, output tax payable, and other particular, these are the mandatory records. So I just tried to correlate the books of account under the GST law, try to correlate the books of account under the income tax law. You can also try to correlate these accounts with the under the Companies Act, and you will obviously find out that the inventory records are per se one of the mandatory records, one of the important ingredients or part of the records of an assessee. I have already touched upon Rule 6F of the income tax rules. So details of cost of drugs, medicines, and other consumables for the medical profession, that is the explicit or the specific requirement which is reported under this particular clause. So section 16, if the goods and services or purchases are used for a furtherance of business, so obviously for personal use, if at all there it is the case, then under section 37 also you cannot claim that particular expenditure if at all it is for the personal purposes, and therefore utmost care must be taken to ensure that there is a disallowance on the face of it by the tax in the tax audit itself. And obviously, there is no input tax credit which is claimed by the assessee in this particular area. The basic examples are domestic traveling or the area wherein you will find certain expenses as personal expenses, or in case of LTA claims, the debit must be to the salary account. And in the upper part of the reconciliation, whatever I was explaining earlier, you can also exclude the salary part. Over here I am talking because salaries per se are not getting covered under the GST law, and therefore whenever LT claims or whenever any LT benefits are being given, in that particular case the debit must be to the traveling must be to the salary account and not to the traveling account, because it is a part of the purpose that are given to an assessee. to his employee. So I just tried to jot down various implications that wherever ITC is not eligible by block credits such as motor vehicles, unless you are in the business of selling motor vehicles or aircraft or vessels, then ITC is not eligible for the general repairs or insurance, or as the case may be. Obviously, in case of staff welfare also or other welfare, unless it is expensive required by the law, ITC is not eligible, and therefore you must correlate that particular activity with the books of account. Then, in respect of food or beverages, you will find many entities as composite dealers, and you will ensure that the input tax credit is not being availed by you. Rightly or wrongly, the composite dealers may state in his so to say invoice, but it is a bill of supply, so to say, per se, as per the eyes of law. They may wrongly call that as bill of supply and they will levy it separately, but strictly that credit is not eligible. Therefore, please note that the entity is registered, but the set off is not eligible. Similarly, for membership in a club, health or fitness center, these are benefits usually given to managing directors or the top class entities of the SSE, and benefits of input tax credit under these laws are not allowable, although the expenditure may be allowable under the various provisions of income tax law. Similarly, for rent-a-car, health and insurance, life insurance, similarly on travel benefits, works contract for construction services, then goods and services used for construction of immovable property, it is not eligible. Composition scheme also it is not eligible, and therefore care must be taken to ensure that we are correctly advising the clients, correctly advising the people to whom we are rendering the services. The responsibility will be much higher. Responsibility will be much higher whenever a particular client is being handled by a single chartered accountant with respect to direct taxes as well as the indirect taxes. Now, there are amendments from 1st of June 2013 for HICs and similar transactions for the taxability or the eligibility of the input tax credit items. Since that is not part of per se a part of this particular reporting of 44 clause, I am not giving significant trust on it, but I would like to invite definitely your attention on this particular fact, because I just tried to make an endeavor just within 24 hours when Chitali sir just called me just yesterday itself to that I am required to deliver my views on this particular topic. Considering the limited time, I also thought that certain things also are put forth in front of you, so as to give a food of thought as to whether the reporting or as to how you will deal with these particular situations. Then there are transactions which are classified under Schedule 3 to the GST schedule, which are not in the nature of goods and services. There are amendments retrospectively from 1st of July 2017 when GST law has come in place, and therefore the care must be taken to ensure that how you are going to touch upon this particular topic legally, and then accounting wise giving effects in the books of account, and then reporting under clause 44. So with this brief, I would like to give once again thanks to the tax audit quality reviewer Chitali sir and the authorities Chawla sir, Singh madam and other authorities for giving me that opportunity for sharing my views. I also thank Abhyankar sir for being present over here, who is an expert in this particular area. So thank you very much.
Thank you, sir. There is a question from participants, sir, but Mukund Abhyankar sir share the views and conclude the session with the question. So please, Mukund Abhyankar sir, please take over the session.
Yes. Am I audible?
You are audible.
Yes, thank you.
Please.
I'm sharing the presentation.
Shall I stop the presentation? Shall I give off the presentation?
Not.
Abhyankar sir, shall I close my presentation?
Yes, yes, please.
Yes, sir.
Is it okay, sir?
Yeah, it is okay. Yes. Share म्हणून.
यावेळेस इथं आम्हाला तुमचा चेहरा दिसतो सर.
नाही पण
प्रेझेंटेशन
असं आहे का? पण मग तसं नको. मला तसं नको.
नाही याच्यामध्ये दिसतं सर आम्हाला. पण ते नाही.
मी हे याच्यावर न घेतो. हा. Should I start now?
Yes, sir.
Yes. That sharing is not possible, it seems. I will share that file subsequently. Today, I will start with whatever important thoughts I am having on this clause 44. First of all, I would like to thank Taxation Audit Quality Review Board, C.A. Chitale sir, Dr. Chawla sir, and my previous speakers, Nikhil and Shekhar. And then I continue with whatever part I think is relevant with clause number 44. The first thing is that this clause comes as the last clause in the tax audit report, but it is not the least important clause because, as Chitale sir had said, it has been an experience that it is occupying about 30 to 40% time of the auditor in getting compilation for this clause. So this clause has become really a sort of a problem in compilation, and being important, it needs some attention, and that is why this seminar has been held. That is what I think. Now, as C.S. Sahni sir has pointed out, many times both direct and indirect taxes are handled by the same chartered accountant, and this becomes at once a task for the chartered accountant as well as some sort of relief, because at his office record itself, he can have some reconciliation with what he is reporting under income tax as well as what he has reported under GST. So to some extent, this is an opportunity as well as a trouble. Coming to this clause number 44, the important thing is that the reason for introduction of this clause in tax audit report cannot be known directly what was the department's perspective in having this clause and making chartered accountants to report on GST part of the transactions of an auditee. Modifications in tax audit report in Form 3CD are generally not introduced in the budget, but are through notifications. So there is no explanatory memorandum which is available for provisions in the finance bill, which becomes handy for knowing the department's or the government's perspective behind introducing these particular changes. So for this clause, which has been introduced for the first time in AY 18-19, but which was kept in abeyance till AY 22-23, the intentions of the department behind having this information through tax audit report are not clear. So we are here left to speculate what is expected from us while we report on this clause. So the utmost importance in this fluid scenario comes from guidance note, which our institute regularly updates members about what is to be reported and what care has to be taken. For this clause also, our institute has come out with a detailed note of explaining what is required under this particular clause. Now, taking to the context for this clause, we will have a parallel report under GST, which is in suspension, which is not asked for. That is ITC in table 14 of GSTR 9C, which requires reconciliation of expense-wise breakup of ITC that is claimed in GST returns and what is claimed as per accounts of the SEC. So that GST law is differing reconciliation to an extent with financial accounts, but the same sort of reconciliation is sought by tax audit report through income tax law. So that inconsistency or lack of correlation needs to be taken into account, that only income tax is requiring some sort of reconciliation with GST, whereas parallel reconciliation with income tax is kept in abeyance under GST law. Problem with clause 44 is that this reporting is using different databases which are designed and created using different sets of principles. So we have accounting principles according to which statutory accounts are made, and GST law requires what is to be reported as purchases and sales. The principles which govern both these type of data sets are completely different. So a reconciliation of these two reports is very, very difficult. So that is why, in my opinion, Institute has given some liberty to tax auditors in the sense that we are, in my opinion, allowed to collect this data for reporting under clause 44 from the auditee, and we are only to verify on test check basis what is the level of correctness that is revealed out of our test checks. So the responsibility of compilation of this GST based data to be covered under clause 44 basically rests with the auditee, and we are only supposed to report the transactions that are reported under GST. So our tax audit report is based on statutory accounts, and it need not have any reflection on the GST portal, because as I've said, the principles by which both these reports are maintained are totally different. There are many examples of how these two different data sets have different bases. First important line of difference is with respect to inter-unit transfers. Under GST, the registration of every legal entity is based on the states in which that legal entity operates. So even if there is a branch in another state, it has a separate registration. So all sale and purchase transaction with branches and units of the same legal entity in other states become intercompany transactions, which are not to be reported under statutory accounts because they are net off against each other. They do not constitute expenditure and income from accounting perspective, but from GST point of view, they become sales and purchases to be reported under different GSTINs. This is one major line of difference which is a major example of different principles governing the two databases. Then there is a particular requirement that GST registrations are different. So while tax audit report is only based on one legal entity, so here we are supposed in tax audit report to consolidate all GST returns for various registrations that are across the states. So it is not that this particular registration is only for one state, it is across India. So tax audit report is for entire country based operations, which must include variety of GST registrations. Another line of difference is that whether an assessee is registered under GST or not, he may be required to get his accounts audited under tax audit. So a GST registration of a taxpayer is not the criteria. Now coming to the relevance of this particular clause number 44, an important information which is already available with Income Tax Department is through form report under AIS and TIS. AIS gives party-wise breakup of B2B purchases, that is business to business type of purchases, as per 2A and 2B of GST law. So this particular reporting, which is already there with Income Tax Department through AIS and TIS, must be kept in reference, because any mismatch which is of a large scale type may invite attention of the tax authorities, because already some information is there, and this B2B type of purchases are mainly coming under column number 5 of table under clause 44. So column number 5 of this table has more or less a direct relationship with what is reported under TIS. So anyhow, under clause 44, Institute has already clarified that we are supposed to give totality figures and not a transaction or party-wise breakup of transactions. Only split that is expected is between revenue expenditure and capital expenditure. So only 2 rows, I think, are required to be given in this table. So this particular B2B purchases, which are coming in column number 5 in these 2 rows, may be very important, because they have already a correlation with the information available with the department, and this big difference between clause 44 reporting under column 5 and information under TIS may be a reason for scrutiny. Similarly, column number 7, which is for purchases from unregistered dealers, that is also one of the checkpoints for the income tax and GST departments, because if there are huge unregistered dealer purchases and the volume of transactions of taxpayer is also huge, then that inconsistency itself may invite the attention of the tax authorities, because normally any organized business will mostly deal with organized businesses of suppliers. So if there are suppliers of any organized business which is carrying out large scale operation is having majority of its purchases from unorganized or unregistered dealers, then it may speak of some scrutiny from tax authorities, basically income tax as well as GST, because income tax may think that some of these expenses which are claimed as purchases from unregistered dealers may not be genuine and may require some scrutiny. So column number 7 is also very important from that aspect. Now we have seen that tax auditor is given liberty to get a statement, detailed statement party-wise from taxpayer about what are the details of transactions, a summary of which is to be reported by tax auditor under clause 44. So before reporting this summary, a test check on the details furnished by the taxpayer must be carried out, and that must be random, so as to give some idea about to what extent the taxpayer, while furnishing this information to the auditor, has given thought for the correctness of this information. Even the systems for reporting under GST may be scrutinized by the tax auditor so as to ensure that the systems through which GST returns are filed and through which this data is generated are sufficient to give correct reporting under clause 44, because most of the information in clause 44 which will be given by the taxpayer to the auditor will be coming through GST related software system. And if this software system is very much aligned and integrated with the accounting system, many of the reconciliation exercises may be taken care of by the system itself. So that part is very important. System related review will give some comfort level to the tax auditor as to whether the data that is reported by taxpayer is sufficiently accurate, and so that he can rely on the data and accordingly report summary figures under the tax audit report. Now, as one can see in this table, there are various categories of purchases that are made from registered entities. And accordingly, there are categories of nil rated, exempted, zero rated, non-taxable and non-GST. Here, one important thing which must be remembered is that exports, there is no tax. They are called as zero rated, but they are not exempt supplies. So whenever there are exports, these are not zero rated. These are zero rated supplies, but not exempt supplies. So there is a difference between nil rate of tax and zero rated supplies under GST. Now, even if a particular transaction like purchase of land is covered under Schedule 3 and therefore outside the scope of GST, still it becomes non-GST type of purchase, and it may require reporting under column number 7 under the head of capital expenditure. So non-GST doesn't mean that it doesn't require reporting. So these are the points which I thought that are relevant and which are not already covered under previous sessions. And since there are a lot of questions from participants, I, along with CS Ani sir, will like to answer those questions, because these are the problem areas for the participants and must be given attention. As I've said before, I will be sharing my presentation so that anyone who is interested to get the soft copy of this presentation will have that presentation. Since it could not be shared on screen during this webinar, I will like to share that copy with the review board so that anybody can have access to that particular presentation. With this, I think I, along with CS Ani sir, will like to address the queries that are posed.
Benkar sir,
Yes.
मी तुम्हीच द्या सर रिप्लाईज. मी आहे पण रिप्लाईज द्या सर. You are more thorough in this area.
No, not it is not like that. Joint and cooperation is always important.
And sir, considering your expertise and all, and your age and
expertise is always cooperative. So let us have this first question, which was asked, is whether in clause 44, is it mandatory to report whether a remark can be given as the information regarding this particular clause is not furnished by the taxpayer? We are unable to give details in clause number 44. A sort of disclaimer, whether such type of blanket disclaimer can be given, is a question that is posed. in my opinion, that if such blanket omission from taxpayer is there, the auditor will be definitely handicapped because he is not supposed to dig out voluminous data of GST and compile the information on his own. So 95% of the compilation work, I think, has to come from taxpayer. So if no cooperation is available from the taxpayer, in my opinion, tax auditor must make his position clear that this particular reporting is not possible in the absence of data furnished by the tax auditor. If you have some different views, Nikhil sir, Sani sir, please.
Sir, I am also a view like you only, but I would like to also add one point that if at all this kind of blanket disclaimer is there, then the tax department will definitely question the basic accounts itself. Because if at all you are not able to report the breakup of registered entity and unregistered entity, then as to how you are filing your GST returns and all those questions would come up. Therefore, I believe that it's very risky on the part of a tax auditor to authenticate this kind of reports and to give this kind of blanket disclaimer, according to me. I mean, obviously the facts and circumstances will differ from case to case, but this is what I feel as I interpret from the basic question. Nothing else, sir. Otherwise, my view is as same as yourself only. But if at all the assessee is saying that I am not able to give the information, then on what basis his accounts are being prepared, on what basis true and fair things are being given, and on what basis GST returns are being filed, will be the questions in front of the assessing officer by giving such kind of blanket disclaimers. Because tax audit is reporting of true and correct, and giving disclaimer does not enable an auditor to escape from his duties. That's what I feel primarily.
Yeah, but what I feel is that this particular clause 44 is restricted to GST related reporting.
Yes, sir.
So by itself, it doesn't question the reliability of accounts as such. One may not have GST related data with taxpayer may not be having, but that may not mean that his accounts are altogether faulty. So
I'm not saying that accounts are faulty. I'm saying that I mean, considering by fact to fact, I believe that it is a. I mean, I will report on the use of fact to fact, not as a general opinion. My view is as same as you, but I feel that I will report it on client by client, considering the reasons as to why he is not able to give that data to the auditor. This is what I
correct. Yeah. The auditor should also reflect upon the reasons for inability of the taxpayer.
When a person is definitely under a tax rate, this means that he is definitely using electronic records. In the era of electronic records, as to why he is not able to give at least the material data. If I understand that he may not be able to give the thorough data, 100% data, but at least 95-80% data he must give, according to me. I mean, this is what I interpret as a casual interpretation.
Okay. Another question is whether GST refund is required to be reported in clause 16B of tax audit. This clause 16B relates to incomes which are required to be considered under section 28, but which is not reported. If the accounting treatment to ITC followed by a taxpayer, which is normally followed, is accounting for it as a current asset, which doesn't come into profit and loss account at all, then refund of that credit is refund of or realization of a current asset. So it doesn't constitute income. So in my opinion, that reporting of GST refund is not covered under section 28. So I think it need not be reported. Next question is that guidance note mentions that total of 6 and 7 must match with column 2, except to the extent of expenditure or allowances mentioned in para 82.2. Para 82.2 states that depreciation under section 32, deduction for bad debts, etc., which are not expenses, should not be reported under this clause. So basically, the query itself makes it clear, and you, CS Sani sir, has also mentioned that reconciliation of what is reported under clause 44 according to financial accounts in terms of what is excluded. He was referring to value part of all those headings. That particular reconciliation table is also available, and that should be used so that whatever depreciation etc. word for reporting under clause 44 will be available as a part of reconciliation, so that if any question comes as to why the figures of expenditure as per P&L account and clause 44 reporting are not matching, auditor will have ready reconciliation available with him, so that that question can be answered properly. Is this okay?
Yes, yes, yes.
If an exempt supply is received from unregistered dealer, then to be shown in column 7 and not 3 in clause 44. No, it has to be shown in column 7, because unregistered dealer, there is separate column itself provided for purchases from unregistered dealer. So it is not in column number 3. So what is asked is correct. It is not in 3, but in 7. Next question is, as per clause 4 of form 3CD, whether the assessee is liable to pay indirect taxes like excise duty, service tax, sales tax, custom duty, etc. Our query is that assessee is liable to get registered under CGST Act during the year, but he is unregistered as on the date of tax audit report. Is it necessary to report the same in tax audit report? In my opinion, whether the taxpayer is registered under GST or not doesn't have any bearing as to clause 44 reporting. So whether auditee was registered under CGST at the time of tax audit report or otherwise doesn't have any relevance to whether that particular reporting under. But clause 4 we have to see. The question is pertaining to clause number 4. Under clause number 4, it needs to be reported, but not under 44.
Correct.
Yeah. Next question is purchases from URD customers of gold ornaments who is not entity need to be reported in clause 44.
Yes, sir.
Yes, to be reported.
Yes, it is to be reported. Just require your clarification in respect of clause 44 as per guidance note serial number 2 should match with 6 and 7. Again, this question is repeated. Then there is a question whether GST on rent paid for immovable property is eligible as ITC. If this property is used for business, it is eligible as ITC. So these are the questions, and with this, I will again like to thank all the participants and speakers as well as committee members for having this seminar. Thank you all.
Thank you, sir. Thank you,
Thank
Nikhil
you.
sir, Sekhar sir, and Mukund sir. Thank you for this insightful session.
Thank you, sir.
Thank you. Thank you so much, sir.
Sir, can you get a recording of this session later?
Actually, I will call you, sir.
Okay.
We cannot.
Okay. I just thought, because it's your recording, I just thought.
And I was thinking of sharing this presentation. Should I send email with attachment of this presentation so that anybody can access? What is the way in which it can be?
Yeah, definitely, sir. You can share your presentation to the taqrb@icia.in.
Yes.
We can share with the participant.
Yes. Thank you so much.
Thank you.
Thank you so much, sir.
Thank you very much,
Thank you, sir.
Thank you very much, Nikhil. Thank you very much. Thank you very much. Very nice of you.
Thank you, sir.
Thank you. Thank you.